A credit spread is a financial concept that refers to the difference in yield between two bonds of different credit ratings. The credit spread is the additional yield investors demand to hold a bond that is considered riskier than another bond with a similar maturity. Credit spreads are an important tool for investors to assess the creditworthiness of a particular issuer and determine the relative value of different bonds. In this video, we will explore the concept of credit spreads, how they are calculated, and their significance in the financial markets. Credit spreads are a measure of the perceived credit risk associated with a particular bond. The credit risk is the risk that the issuer of the bond will default on its debt obligations. Bonds with a higher credit risk are considered riskier investments and require a higher yield to compensate investors for the additional risk. The credit spread is calculated as the difference in yield between a bond with a lower credit rating and a bond with a higher credit rating. For example, if a 5-year bond issued by a company with a credit rating of BBB yields 4%, while a similar 5-year bond issued by a company with a credit rating of AAA yields 3%, the credit spread between the two bonds is 1%. Credit spreads are typically expressed in basis points, with 1 basis point representing 0.01%. In the example above, the credit spread would be 100 basis points. Credit spreads can be calculated for any type of bond, including government bonds, corporate bonds, and municipal bonds. They can also be calculated for different maturities, such as 1-year, 5-year, and 10-year bonds. Credit spreads are an important tool for investors to assess the creditworthiness of a particular issuer and determine the relative value of different bonds. Higher credit spreads indicate that investors are demanding a higher yield to compensate for the additional credit risk associated with a particular bond. Credit spreads can also be used to identify trends in the financial markets. For example, during times of economic uncertainty or market volatility, investors may demand higher credit spreads to compensate for the increased credit risk associated with certain issuers. Similarly, during times of economic growth and stability, credit spreads may narrow as investors become more confident in the creditworthiness of issuers. Credit spreads can also be used to identify potential investment opportunities. Investors may look for bonds with wider credit spreads than their historical averages, indicating that the market may be pricing in more credit risk than is warranted. In addition, credit spreads are an important tool for fixed-income investors who are seeking to construct a diversified portfolio of bonds with varying credit ratings. By investing in bonds with different credit ratings, investors can achieve a balance between yield and credit risk. While credit spreads can be a useful tool for investors, they are not without risks. Credit spreads can change quickly in response to changes in market conditions, economic indicators, or changes in the creditworthiness of issuers. Credit spreads can be influenced by factors that are not directly related to the creditworthiness of the issuer, such as changes in interest rates, market liquidity, and investor sentiment. As a result, investors should carefully consider the risks and potential rewards associated with investing in bonds with different credit ratings, and consult with a financial advisor before making any investment decisions. Credit spreads are an important tool for investors to assess the creditworthiness of a particular issuer and determine the relative value of different bonds. Credit spreads can be used to identify trends in the financial markets, potential investment opportunities, and to construct a diversified portfolio of bonds with varying credit ratings. However, credit spreads are not without risks, and investors should carefully consider the risks and potential rewards associated with investing in bonds with different credit ratings.